This week on the Retirement Quick Tips podcast, I'm talking about how to handle stock market corrections. As I record this, we've officially entered correction territory. Right now, it's kind of teetering back and forth with the 10% downturn that defines a correction in both the NASDAQ and the S&P 500. Today, I want to talk about keeping your emotions out of your investment decisions. I've already suggested if you are over-concentrated in stocks, particularly riskier aspects of the markets, or even things like Bitcoin, take the opportunity that the correction has provided. I think it has actually snapped a lot of people out of the complacency that they're in for good reason, because I see a lot of people, a lot of investors very close to retirement that have very high concentrations in stocks, and particularly certain areas of the stock market or even other investments, like I said, Bitcoin, where too much assets in too few areas is just a recipe for disaster. Now, I also mentioned earlier this week that 401k trading activity was like 4 times what it was in the early part of March. So that's really saying something, because 401k investors, they tend not to be actively trading their accounts. But a lot of people have been really spooked and moving money into bonds, money markets, safer investments compared to what they were in. I think while it is a good opportunity to rebalance and reduce your risk, it's also very important not to panic and go too far in the other direction. If you're closer to retirement and you have a pretty typical risk tolerance, somewhere in the range of 50 or 60% in stocks, I would say is going to be appropriate for most people. You're probably fine if that's the general range that you're in as far as your overall portfolio allocation to stocks. It's the people who are 75, 80, 90% in stocks who are also close to retirement who should be really seriously looking at rebalancing, moving some of the risk out of their portfolio. What concerns me, though, about this pickup in the 401k trading is that I think a lot of people out there, they're not dumping their like super concentrated high risk stock funds. They're getting out of like their target date funds, which are generally pretty well diversified. If they're in the right target date funds, it has a good mix of stocks and bonds. Is probably appropriate for them, again, if they're in the right target date fund. And so they're selling a lot of these target date funds and they're putting it in like the hide it under the mattress stable value fund. And so in that case, they're really letting their emotions send them too far in the other direction. And this is really bad for several reasons. First of all, the odds that this correction is the beginning of like a deep, dark, scary bear market are just not consistent with actual history. Most corrections turn around and aren't the sign of something deeper. So people, when they have these emotional reactions and they panic and the pendulum swings way too far in the other direction, then what ends up happening is they sit in that stable value fund or like the ultra conservative bond fund or cash-like fund. They sit there because they're always waiting for the next shoe to drop. Most people who let their emotions dictate their investment decisions, they actually don't make much money in terms of their overall long-term returns. The data clearly shows that investors tend to get in at the top and then they get out when the market takes a beating. So in other words, their emotions cause them to buy high and sell low. If they would have just picked a good quality, diversified investment portfolio like a target date fund that aligns with their retirement date, and they stuck with it, good times, bad times, most people are going to be okay. But a lot of people, they don't do that. And their real world returns, like their actual investment returns, when they got in and out and they were making decisions based on emotions and worries and like the fear and greed and all of that, it didn't work out. And so people look back and they're like, I've been invested in my 401k for the last 25 years, but I don't have a lot to show for it. And most of the time, it's because they were allowing their emotions to cause them to get in and out of the market at exactly the wrong times. And so it's just not leading to this meaningful creation of wealth over time that people are expecting and hoping for when they invest in their 401k. Okay, so I already mentioned it, but people who panic and sell everything, they usually wait a very long time to get back in. Some people never get back in. I had a client that I was working with a number of years ago. This was like maybe 2010, 2011. So the scars from the global great financial crisis were very raw still. Like the wounds have not yet healed. And so I had only started working with her for maybe like a couple of years and not prior to the global financial crisis. So I don't know what her behavior was. But I remember at the time in this 2010, 2011 range, she had sold everything in her 401k. And she was pretty close to retirement at the time, had a substantial balance in her 401k and just sat in cash. And for those couple of years that we worked together, I would plead with her to get back in because what she was doing was not a long-term investment strategy. Sitting in cash was not an investment strategy. And unfortunately, this is very common. People will wait years for a variety of reasons. I think, they've talked themselves into like the next shoe's going to drop anytime and I'm not going to get back. And they're convinced that like, hey, as soon as I get back in the market, like then it's going to take a nosedive. And so they just kind of sit there and never jump back into the pool. But of course, that is a horrible recipe for long-term wealth creation as well. And it never works. It's a really bad sign. And it happens, unfortunately, all too often. So if your portfolio is roughly in line, the allocation is roughly in line with where you should be based on your age and your stage in life and your risk tolerance, then try to ignore the noise. What I'm trying to convey in this week's theme is if you are over-concentrated, if you are overvalued, get back in line with where you should be. It's like the kids in like first grade. Some of them, my son's in first grade and, sometimes he wanders off and it's like, get back in line. Once you're in line, it's all good. Then you can go out to recess. It's going to be okay. But if you are getting caught up in like the emotional or you're either too much in stocks because you've allowed that complacency to set in over the last several years, or now you've gone too far in the other direction and panicked, or you're considering that and going, putting it all under the mattress, that's a problem too. So we have to kind of Goldilocks this right in the middle and make rational decisions, long-term focused decisions, not get caught up in the daily swings of the market, and make sure you think in long-term with your finances, not just what's going on in the market right now. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.